Hello everybody. At this time we are talking about market efficiency. Market efficiency is a foundational concept in finance that revolves around how well financial markets incorporate and reflect all available information into asset prices. In a sense, in a perfectly efficient market, the prices of assets such as bonds, stocks, and commodities fully and accurately reflect all known information at any given time. This implies that any new information, whether it's about a company's financial performance, economic indicators, or geopolitical events, is wholly and swiftly incorporated into asset prices without delay. In other words, in an efficient market, it is nearly impossible for investors to consistently outperform the market or earn abnormal returns simply by analyzing publicly available information, as asset prices would already reflect all relevant data. Market efficiency is crucial for investors, policy makers, regulators, and economists, as it provides insights into how markets function, how assets are priced, and how resources are allocated within the economy. Understanding market efficiency helps stakeholders make informed decisions, develop investment strategies, and assess financial markets' overall health and functioning. And then we move to levels of market efficiency. The first level, weak. In this type of market, the investors perceive that the market is inefficient and the market only has information regarding past price movements. When this information is available, the technical analysis of past prices and volumes may not be useful for an investor. New information would be required to beat the market. For example, an investor seeking post price and volume patterns from the technical chart may be unable to predict future moves due to multiple resistance or support levels. And then second, semi-strong. This stage provides investors with the support of more factors affecting the market. Here, the public information of news, financial regulations, public reports, etc., are publicly available for assessment and can help reach some valuation levels for that instrument. Analyzing only the company's financials may not help investors at this stage and would require a competitive analysis of the available public details. And then third, strong. It is the situation when there is ample availability of information in the market and all the investors can easily take benefit of the same. In such a case, The price gap can be filled quickly due to ample availability, and markets will be moving collectively. Due to this widespread availability, investors may not violently under valuation in the market. For example, when a company's management is revamped and is positively growing in all terms, investors may not be able to find space for undervaluation or overvaluation. And then we move to characteristics of an efficient market. First, free and fair competition. In an efficient market, everyone has an equal chance to access information and trading opportunities. This ensures no single entity can manipulate the prices or control the market. And then, second, immediate and accurate price reflection. In an efficient market, prices adjust quickly and accurately to incorporate all the relevant information available. And then third, low transaction costs. In an efficient market, transaction costs such as brokerage fees are very low. This allows investors to enter and exit the market without significant impact on prices. And then fourth, elimination of arbitrage opportunities. In an efficient market, any arbitrage opportunities are quickly identified and taken advantage by the market participants. This helps in aligning prices across different markets and prevents arbitrage opportunities from persisting. And then we move to the implications of market efficiency. The efficient market hypothesis has several implications for investors. If markets are efficient, it means that it's hard to beat the market. Since market movement is primarily determined by new information, which is by nature unpredictable, then results should be random and unpredictable. As a result, this theory implies that no amount of analysis can give an investor an edge over other investors, known as the random walk theory. This theory suggests that stock price changes have the same distribution and are independent of each other. So, the past movement or trend of a stock price or market cannot be used to predict its future movement. And then we move to the factors influencing market efficiency. The first factors, information availability. The availability and dissemination of information play a crucial role in market efficiency. In highly transparent markets where information is readily accessible to all participants, asset prices are more likely to incorporate new information quickly and accurately, leading to greater market efficiency. And then second, macroeconomic factors. Macroeconomic conditions, including economic growth, inflation, interest rates, and geopolitical events, can impact market efficiency by influencing investor sentiment, risk perceptions, and the flow of information in financial markets. And then third, market participants. The behavior And characteristics of market participants, including investors, traders, and institutions, influence market efficiency. Rational and well informed participants contribute to efficient price discovery, while irrational behavior, hoarding instincts, or market manipulation can distort prices and compromise efficiency. And then fourth, market frictions. Frictions such as transaction costs, imperfections, and asymmetric information can impede the efficient functioning of markets. These frictions may create opportunities for arbitrage and contribute to deviations from market efficiency. And fifth, regulatory framework. The regulatory environment, including securities laws, market regulations, and enforcement mechanism, can impact market efficiency. Strong regulatory oversight and enforcement help maintain market integrity and enhance investors' confidence, contributing to greater market efficiency. I think it is enough. Thanks for watching.